The sky is not clearing up for the automotive industry. Big clouds continue to gather over the industry as it faces significant challenges, which might result in a 50% downturn. From the economic factors, rising interest rates, and market decline, new and used car dealerships have been impacted by this turn of events. On the verge of this collapse, businesses like CarMax and Carvana are struggling to stay in line. The automotive market has been on the verge of collapse for some time, brought on by various events that have created the perfect opening for reducing car prices. The first event is the rising prices and exorbitant interest rates. With rising prices and exorbitant interest rates, vehicle demand has dramatically waned. Companies like Carvana have overexpanded their stocks and incurred huge debts. Being an Amazon-like car dealer, which gives customers a chance to order a car online and have it dropped at their doorstep, the COVID-19 pandemic period is a good market year for them.
See Carvana, you've got Nirvana. That's what this market's about.
A reason for expanding their operation. With used car prices already down by 8.8% in the previous year, and the interest rates hike expected to continue into 2023, pressure on the industry continues to rise. Another factor contributing to the decline in car prices is the low financial power of buyers. As the Federal Reserve increases rates to combat inflation, it has become harder for people to commit to a monthly payment for a new or used car.
And you look, everything you see is new.
In December, the average interest rate on used car loans was 12.37%, up from less than 10% a year before. Since used car buyers typically have lower incomes and are more susceptible to rising interest rates, the used car industry has suffered most from the situation. The third factor causing the reduction in car prices is the increasing stock of new and used cars while the demand continues to drop. This higher supply than demand has caused a competitive environment whereby car dealers slash their prices to attract customers. This in turn further accelerates the market collapse. As the potential for an auto market crash increases, industry giants like Carvana and CarMax struggle to maintain their financial stability and the business as a whole. Carvana, the online-only used car dealer, famous for its unique multi-story car vending machine,
everyone viewed Carvana as the stock that was going to skyrocket,
suffered a 95% decrease in its share prices over the past year. A whopping 95%. Factors such as skyrocketing interest rates, the company's overexpansion, and overbuilding of its business activities, which resulted in significant debt accumulation, are all blamed for this massive drop. Carvana's financial number was a great depiction of the company's current position, with a 25% decline in profit per vehicle in 2022, total debt amounting to $9.25 billion, and only $650 million cash on hand. Also, the company recently reported a $2.67 loss per share. Many analysts are now predicting the future of Carvana.
As with many one-time Wall Street darlings, the excitement around the online used vehicle retail.
The media are included too. The media sources claim that creditors have already agreed on how to conduct negotiations with the company in the case of bankruptcy. Given this development, the future of the company is looking bleak. CarMax, another used car giant, is also hurting, although it is on much steadier ground. Over the last year, CarMax's shares have dropped about 40%, indicating that even well-established companies need help adapting to the rapidly changing used car industry. The Virginia-based company, which operates nearly 250 dealerships across 41 states and an automotive financing unit, faces many challenges as the auto market collapses.
It gives customers the simple experiences they're looking for with low prices and great selection.
CarMax's recent earning data revealed some alarming figures. The company's earnings per share decreased by 85% compared to last year's. It even falls short of the 60% Wall Street's analysts have predicted. Furthermore, its sales were 21% lower in Q3 2022 compared to Q3 2021.
Its revenue had more than doubled from the previous year, and its
revenue dropped 24% to $6.51 billion. While CarMax's situation may not be as gross as their rival Carvana, the company's situation serves as a reminder of the ongoing auto market change and the need for the companies to adapt to survive. With the sharp decline in used car prices and the ever-increasing auto loan interest rates, customers and businesses in the auto industry face hard times.
Rocketed by over 1,000% from a low point in 2020.
As the Federal Reserve continues to raise interest rates to overcome inflation, it has become harder for Americans to afford the monthly payment for new and used cars. Since used car buyers typically have lower incomes than new car buyers and are therefore more susceptible to interest rate hikes
than some people thought, to kind of break into the used car market,
this has negatively affected the used car market. The effect of the Fed rate hike on the used car market is further exacerbated by the fact that auto loan interest rates for used cars are greater than those for new ones. So as interest rates grow throughout 2022, the biggest drops in auto purchases were observed among low-income customers.
This quarter we sold over 100,000 cars, and this year we'll sell 1,000 times as many cars we sold that first.
This situation led to a 10% annual decrease in used car retail sales. Another factor affecting used car sales is the increasing supply of new cars, which diverts some customers' interest away from the used car market.
Keeping fueling growth was the rising cost of used cars.
According to the Manheim Used Vehicle Value Index, the wholesale used vehicle value, based on the amounts paid by dealers at auctions, decreased by 14.9% last year. According to Cox Automotive, these values will drop by 4.3% this year. Although retail prices typically lag behind wholesale costs by a small amount, the decline in used car values is notable. However, it is worth noting that used car prices soared by an astounding 88% during the pandemic. Using this as a base, Cox Automotive experts believe the present decline may soon reverse depending on the Fed's regulations. Further decreases in vehicle loan interest rates are anticipated to result in cheaper pricing and more accessible purchasing options. As a result, this should make customers' monthly payments more manageable and support increasing demand in the second half of 2023. Even if the used car market has a difficult path ahead of it, there is a chance for a comeback as borrowing rates and automobile costs decrease to more bearable levels for customers. The future of the auto market appears cloudy as it grapples with a reduction in car prices and increasing interest rates. The anticipated continued decline in used car prices may affect the entire automotive industry,
May depend on how it continues to handle growth.
creating uncertainty and the possibility of financial hardship for consumers, car dealers, manufacturers, and manufacturers. Dealerships may see more pressure due to the ongoing decrease in used car values, pushing them to cut back on operations and inventory to survive. As smaller independent dealers struggle to compete with larger, more established competitors, this could result in job losses and more industry consolidation.
In terms of our long-term outlook and where we want to be for the business.
Also, if the Federal Reserve keeps increasing the interest rates aggressively, lending will become expensive for both customers and dealers, which will be a disaster for both sales and profitability.
There's been issues with state regulators over the years for things like
Customers may grow more reluctant to commit to monthly payments for both new and used cars, which could cause the market to experience a protracted downturn.
I think that they will have to perhaps scale back some of their growth aspirations.
The possibility of a global economic recession, which could make things even worse for the auto industry, adds to the bleak future. In such a situation, consumer spending may decrease and loan availability may become more challenging, thus reducing demand for automobiles. In summary, the future of the automobile market is gloomy, as there's no hope of a turnback from the collapse it's experiencing. With car prices expected to decline further and uncertainty surrounding the interest rate market, the auto market is expected to struggle for another round of unknown years. What do you make of this video? Can the auto market bounce back from this impediment, or will it still be on the downward slope? Let's know your prediction in the comments section.